Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.
Hey guys, this is Justin. In this episode of Excess Returns, Jack and I talk about our experiences, successes, and failures in the building of Validea and Validea Capital Management. The conversation focuses on learning from our mistakes, but what we also point out is the process of learning from those mistakes is a delicate one, and sometimes you can take those lessons too far the other way. The discussion is less about investing and more about our experiences and what we've learned about ourselves over the past 20 years in building these businesses. Thank you for listening. We hope you enjoy the discussion. What if I wear my sunglasses for this one?
Yeah.
All right, this week we're going to change it up a little bit, and we're going to work off one of the articles that you wrote actually in July, The Danger of Learning from Your Mistakes. And this isn't so much an investment-related piece, although there are many things related to investments in here because for most of our careers, this is what we've been doing. We've basically been building two companies, a research-based business and a asset management business. But maybe to start, we could focus on the research business. So I started with John Reese, the founder of the firm, in, I believe, 1997 or 98, and I think you were almost immediately right after me, maybe within 6 months. You were hired by John as well. So let's just talk about that early experience and like what the company was then and sort of some of the things we were doing. And then we can try to relate it to some of these lessons from mistakes and maybe how we took it too far coming out of it.
Yeah, this is probably the biggest example I have in my career of maybe learning a good lesson, but learning the lesson maybe too much. And so, like you said, when we started off with Validea, we were just out of college in the late 90s. We both started as interns. There was maybe 5-6 people at that point working out of John Reese, the founder's basement. And we started right in the middle of what was becoming the tech bubble. And so companies like ours, technology companies, internet-based companies, were just getting ridiculous valuations. And so we all had our dreams, obviously, of our multi-million-dollar paydays we were going to get. We're sitting here working in this basement and thinking about all the riches we're eventually going to have. But, people did invest. And we took a couple rounds of financing. We took, I think it was like $4 or $5 million in venture capital. We expanded the business to 50 plus people. And, not just coming from ourselves internally, but from the venture capitalists, the mandate was not make money. The mandate was not generate revenue, although generate revenue was nice. The mandate was we need as many eyeballs to this website as we possibly can. Don't worry about any of that. Don't worry about making money. Don't worry about, generating sales. And so we grew the business to, I think it was 52 people. You can correct me if I'm wrong, but
yeah,
I think it was
I think it was over 50 for sure. Yeah.
Over 50 people. And, obviously, the end of the story is what you would think would be the end of the story, given what would happen at that time is, it didn't work out. Obviously the whole focus on, not generating any profits and, in 2000 when the tech stocks started to go down, that affected private companies and, people weren't interested in money losing private companies anymore. And that's effectively what we were. That's what we were trying to be. We were trying to be as big as we could, not taking into account income at all. And so, that was sort of the formative part of what we, of the early part of our career was we added all these expenses, we added all these people, we grew this huge company, and then it blew up on us. And so going forward, what lesson do you take from that? Well, the lesson I took is you really have to be very careful about managing your costs. You have to be really careful about adding people and adding expenses. And so as we sort of restarted a new version of Validea with sort of a different product set starting in 2003, that I had that with me the whole time. And so as we've grown, it's Validea is me, you, John Reese, and then, some part-time people. That's basically what it's been from the beginning. We've stayed with that. We've never really added employees. We've never, spent tons of money on marketing our growth. And we've done very well. We were able to survive things like 2008 that a lot of other people were not able to. But I do have the feeling looking back that if we hadn't learned that lesson as much as we did, we may have spent some more money to grow the business. We may have built our team a little bit more. And maybe we would have, although we've had a successful company now for 20 years, maybe we would have a more successful company if we've been more willing to invest back in it and hadn't learned that lesson maybe too much earlier in our careers.
Right. Just a couple things. I think, my department, this is back in the first version of Validea. I think I had like 30 research content analysts under me. And we were basically summarizing recommendations that were appearing in the financial press and then tracking the performance. That was a product that existed. It doesn't exist anymore. It's not part of the Validea research site now. But one of the things that I sort of talk about or think about is, my first real job, I not only built a team of roughly 30 people and managed them, but then I basically had to fire them all. So, within like a 3-year period or whatever it was, it's like, I grew this big team, I was managing them, and then we had like multiple rounds of cuts as the VCs sort of were asking us to, rationalize the business and try to save money and try to, get bought or whatever it was to try to survive. And like you said, that company was dissolved. But some of the technology and some of the intellectual property that John had owned, that sort of formed the foundation or the basis for the sort of phase, the second Validea coming out of that in 2003.
Just as an aside, nobody's ever done that media buzz thing we were doing. Just to explain what it was, we were trying to hold anybody in the financial media, TV, et cetera, who made stock recommendations accountable. And so we were summarizing every article, every TV appearance. We were categorizing it by person. So if Jim Cramer was making all these recommendations on CNBC, we were summarizing every one of them and tracking its performance over the, 1 year after he made it, 1 month after he made it, 1 week. So we were trying to hold all these people accountable for all the articles and TV appearances. And, I don't know, do you know, has anybody else ever tried
really.
that?
I think Tip Ranks may do something like that. But in terms of like scouring the media and tracking these recommendations that are appearing, I'll tell you, I think the amount of like stock picks, just if you just isolate CNBC, you still have Barron's. Business Week is now owned by Bloomberg, but Forbes as a magazine doesn't. They used to have Ken Fisher's column. He used to have stock picks. So it's this idea of publicizing these stock picks and investment ideas has really just dwindled away to some extent, and probably that's good for a lot of investors because what we found after tracking 120,000 recommendations was that none of there wasn't any predictability over any period of time in who you could follow based on their past performance. And by the way, a lot of that methodology sort of was derived by looking at the Holbert methodology because he was doing it with newsletters. That was kind of he was the guy that tracked the performance and the recommendation in the investment newsletters, and we were trying to take it and apply it to the recommendations in the media. But where I wanted to go with you was, so let's bring us through. At one point we were sub-advisors for one of the largest banks in Canada. They hired us to run mutual funds, and we had a great run. And we had a few funds, and those funds got very big in Canada. And as a company, that amount of revenue coming in from that piece of business was quite substantial. And to your point, we didn't turn around and plow it into the business because I think to some extent those experiences early on were influencing us.
Yeah, I think that's a really good example because when we did get that big piece of business, it was sort of a weird way, and we got it because it was somebody who used our research website. And so, they were followers of what we were doing in general, and we started sort of from scratch with them. Those funds we ran had no assets in them effectively, but some seed money when we first started, and then they grew over time. And so, what we missed there is we didn't realize as those funds grew, we should have grown ourselves too. We should have taken the money from those funds and we should have, tried to scale up our business. And I think this early experience is probably part of why we didn't do that. We were so worried about, well, what if things go south on us, and we want to be the one that survives, that we probably didn't scale that up as much as we should. But the flip side of that is, we know a lot of, in that 2008 period, there were a lot of firms that were sort of in the space we were in that didn't make it out the backside. And so this focus on, keeping costs low and, operating a lean business, that allowed us to continue to exist where maybe others didn't. So, I'm not saying this lesson is a terrible lesson. It's just there's degrees of learning all these lessons. And if you take it too far to an extreme, a good lesson can become a bad lesson.
Yeah, and we've been profitable since day one. We've never taken outside capital, since '03, since the first version of Validea sort of dissolved. So that's sort of, I feel like core to that experience is how we kind of have built the business and being able to survive over time. The other point that you were talking about in the article is learning the right lesson at the wrong time. And I think here is where you kind of did bring it back more towards the investing space.
Yeah, so the easiest example is 2008. So if I'm invested 100% in equities in 2008 and my portfolio gets decimated, the lesson I might learn from that is I have way too much risk in my portfolio, and I just can't handle those ups and downs. The problem is when you take a lesson like that, you've also got to be careful about when you learn that lesson. And so if I finally reach my breaking point in February or March of 2009, and I'm like, I'm not going to take this anymore, there's too much risk in my portfolio, and I sell my equities and I move to bonds or something like that, well, I've made a massive mistake that's going to hurt my long-term returns. And so the best thing to do in situations like that is to also understand that, all right, maybe I've learned this lesson that I have too much risk in my portfolio, but maybe when the market's down this much, it's not the right time to learn the lesson. Maybe what I should do is keep that lesson in mind, and when things are good again, maybe then is when I say, all right, let's de-risk my portfolio and let's learn that lesson. And you can give what's going on with value right now as another example of that may or may not work out the same way. If you've learned, one of the things about value is it's incredibly volatile. It has long periods of underperformance. And if you didn't know that coming into investing in value, and now you've been sitting through this horrible period, well, now you're learning a lesson. Maybe value is not for me. I can't sit through this volatility and these long periods of underperformance. But if I learn that lesson today, maybe 5 years from now, I'm going to really regret when I learned that lesson. I may not regret learning the lesson because if the volatility of value is too much for you, then it is. But you have to be careful about when you learn these lessons because learning them at the wrong time can be really destructive.
One of the things that we've talked about a lot in terms of our portfolio construction and how we mix these strategies is, for the most part, we've been, largely systematic value investors. About 70% of the strategy, 65 to 70% of the strategies we run are value. And then we have the rest are like in this growth and momentum camp. And we've been sort of believers in, having at some point here, hopefully, a reversion in value stocks and systematic value investing type strategies. But I also think, one of the things that we've talked about is once that reversion comes, and, it's a little bit of a timing thing, I guess, but, when we look to build strategies in the future, I think after a really good run in value, knowing what we know now, that value can go through these very long periods of underperformance, and a lot of people can't stick with it. We've discussed sort of integrating, having a little bit more of a balance between value, momentum, and growth coming out of that period or after that period.
Yeah, our weighting has always been a little bit more towards value and, sometimes a lot more towards value like it is now. And the reason for that is when we look through all this academic research and when we comb through all these papers, more of the papers that have really good long-term records are based on some sort of value metric than anything else. And so it's not us necessarily making a decision, value is better than something else. It's more us looking at all the academic research, and there's just more of it around value. But I think your point's well taken is, we have to learn that even, a 70-30 blend towards value might be too much, for a lot of people to take. And certain people, that's great. Certain people want to invest in value and they can sit through the ups and downs, and that's great. But for other people, maybe a bigger blend among all the different strategies is a better, more appropriate thing. I don't know that now is necessarily the time for that, with value as out of favor as it is, but I do think that that's an important lesson. And I think for most people, single factor investing is not a good idea because these factors have such long periods of underperformance. And by blending them all together, you can get a very similar return, but you can do it with less risks. And so I think for most people, if they are going to be factor investors, some sort of blend among the factors is best.
This next one, the last part of your article where you talked about luck and how luck, especially in investing, can have big influences on whether or not somebody does really good or bad, or in the short run in particular. You kind of use the example of, and what's happening in the market right now is a lot of these investors, retail investors, are buying these companies that basically have filed to go bankrupt. And the stocks have actually, because of the flows, the stocks have actually done well. But yet these companies have basically said, we're going bankrupt, we're liquidating, obviously debt holders are first in line to get anything. So, that's an example of those investors. That's really just, it's what's happening in the market, but that's not a good investment strategy. But the fact is they're probably thinking in their own minds that, wow, I am a great investor because I was able to, buy this company and it went up 80% in 3 days. And, so they're confusing this idea or the role that luck plays in those decision-making processes, which is why I think your point was, focus on the process and not the outcome.
Right. So when judging process against outcome, I think the question you always have to ask yourself is, am I playing a game where luck plays a role? And so if I'm playing you in chess and you win, you were better than me. There's no luck in chess whatsoever. So in chess, I can worry about the outcome. I can judge myself based on the outcome, not the process. But with investing, there's a lot of luck, especially over short-term periods of time. And so if I try to judge the outcome only and don't look at the process that got me to that outcome, then I'm going to likely draw the wrong conclusion and I'm going to make a mistake going forward. And your example with bankrupt companies was a really good one. Investing in bankrupt companies long-term has been a horrible, horrible thing. It's really never worked. And so is it possible, I guess, that, the people that are buying bankrupt companies now will do well? I mean, I guess it's possible, but even if they do well now, if the conclusion they draw is bankrupt companies are a good investment, well, then next time we have something else happen and there's bankrupt companies, they're going to buy those bankrupt companies. And they're going to have learned the wrong lesson. They're going to have focused on what happened, which is they made money with bankrupt companies now, and not the process, which is investing in bankrupt companies is a terrible long-term strategy. And so I think it's important, in something like investing, it's very important to focus more on the process that got you there. I mean, the outcome is, especially over long periods of time, the outcome does matter. But it's really important to ask yourself, was this a sensible process that got me this outcome? Because if it's not, and you got a good outcome, it's likely going to lead to you making mistakes in the future.
So we know this one was different, not really too focused on investing. But what we wanted to do is, just share some of the things that we've learned from both our mistakes, how we manage money and how we build strategies, and just how we've built this business over the last 20 years. So hopefully you found some of that interesting and valuable. And thank you for listening. We will see you next time.
Thank you.
Hi guys, this is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJ Carbonneau. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.